Now, welcome back. Now, the South African Reserve Bank is among the central banks that have been proactively hiking interest rates in order to achieve price stability from early this year. With inflation at more than a decade high in some countries, policymakers have turned towards tighter monetary policy. Now, the International Energy Agency estimates that by the end of the year, 30 million more Africans will be unable to afford basics such as food, cooking oil and energy. And some economists warn that the impact of increasing interest rates in South Africa could be devastating. Development economist Phelisa Nkomo joins us now for a conversation on these matters. Phelisa, thanks so much for your time. Welcome to Morning Live.
Hi, good morning, Sakina, and good morning to the listeners.
So as you know, there have been divergent arguments on what the causes of our inflation are, as well as how to manage it. Some economists argue that South Africa's inflation is not demand-driven because most people are not working. So what are your views on the causes of inflation in South Africa and, of course, the approach to adopt in order to try and curtail it?
Yeah. So, all right. So there are several things that, in fact, actually monetary policy requires what we call mixed monetary policy instrument for you to manage any economic crisis. I think that's the first issue. I think the second issue I need to make a point is that macroeconomic austerity measures does not contribute into building vibrant economy, which allows citizens to have access to work opportunities or income. That's the second point. And then let me come to the question you're asking, is that it's true that there are divergent views, and part of the divergent views is the fact that the policy instruments that the Reserve Bank has at its disposal are actually a lot more than the price stability that we are consistently subjected into. That's one. I think the second issue, yes, it's true that inflation is one instrument, but also at the same time, we are using, for instance, interest rates to manage inflation, which is called, it's a cost push inflation. In this context, it's actually supporting the supply side instead of the demand side. And the danger about over-focusing on the supply side is that, in fact, you're actually choking the very demand side, which is meant to be actually building a vibrant economy. So in essence, when you have high unemployment that is above 30%, right? You actually, in addition, you because of interest rate increases, you're actually introducing a new burden because it means that you are actually reducing the purchasing power of the rand, of the currency by increased interest rates. So let me just say, for example, there is an inverse relationship between interest rate increases and private sector investment. So every time we increase interest rates, we must always know that while the president hosts investment conferences, is that either some of the investments are likely to be delayed because interest rate increases lead to increase of capital cost in the economy. And it means that even private sectors who are thinking, private sector companies who are thinking of expanding their firms or looking at new investment destination, South Africa is not going to be on the radar. However, the group that gets to benefit from interest rate increases are those people who have surplus income, who can invest, which is in this context, who can invest through the banks, but also the other group that gets to benefit is the banking sector, because then immediately, I'm sure you and I, Sakina, already on a Friday, you got your SMS from your bank that says, by the way, be alerted that we are just going to increase your interest rate immediately, because we know a lot of South Africans, for example, actually accumulate most of their assets and wealth through financial industry, which through the banking sector. So in essence, you can imagine already, you know that from your income, a good 400 to 600, has just gone off based on interest rate. Now, if you rely on credit to finance several aspects of your life, both as an individual, but also you can imagine when you finance your business through credit, because you either have not inherited any trust fund from anywhere else. So it means that so it's actually a leakage to individuals, but as well as businesses. Now, your last point is what needs to be done. So the key question here is that I make the point about mixed policy tools, right? The first issue about the Reserve Bank mandate in South Africa, which we're shooting ourselves in the foot, and I'm just going to make a quick example. Federal Reserve of US has a dual mandate. The first one is creation of maximum employment. The second one is price stability. In South Africa, we've chosen only one instrument, right? And which in essence, we are not giving Reserve Bank, an opportunity to be able to manage the situation in as far as actually the economy, when the inflation, which is the supply side of the inflation, and which is driven by fuel and as well as food costs. But interestingly, and I want to make this contrast, the US has increased its interest rate by 25 basis points. This is one of the biggest economies, by the way. But also, they had to do the 25 basis point to manage the supply side pressure, but at the same time, how they deal with the demand side of the economy. One, we've seen reduction in terms of food prices globally, because what the fiscal side of the economy has done to support the monetary policy is to increase wheat production. We've seen oil reducing. We've seen as well as some basic foods like potatoes, because what they've done is that they've then went into the agricultural sector and said, increase your production to support domestic demand or domestic consumption, so that citizens are not choked with having to pay high prices of food. In South Africa, we still say, a lot of people are still going to struggle with high prices of food. So if, for instance, and I think I've been reflecting on this in the last few days, as there's a poor macroeconomic coordination in South Africa, and that's why you have this issue. Because if you have, weaker industrial output across as the economy, what the Reserve Bank is going to be left with its own singular mandate, is that it's just going to choke the economy by just increasing interest rate all the time, because we've not empowered them through a constitution by giving them a dual mandate. But I even raised another issue, Sakina, that in fact, by the way, there is an embedded dual mandate in the Reserve Bank. And I'm really opening a can of worms here, because I know a lot of economists will come for me, but I want that conversation to come through. It says the Reserve Bank must make sure that it controls the price, the price of the currency, including balanced sustainable growth. Now, if you look at the concept of balanced sustainable growth, it's about managing the economy in a way that you don't create future problems for the future generation. And the key question for me is, if, for example, this economy is subjected to consistent increase in interest rate, right? Are we not actually, by the way, passing on the future problems of this country? Because it means that if you and I are not able to sustain our bonded homes and all other credits, it means that the future generation is actually going to be incurring the debt, at a household level, but as well as the national debt in as far as what the current fiscus is carrying right now.
So it comes back to the question that I think we've asked so many times. I personally have asked so many times, in terms of who then listens to whom in this regard. Because one could argue that regardless of what other economies are doing, if you look at the South African situation, practically speaking, if you start increasing interest rates in an economy that has, some of the highest unemployment rates, and you have the poverty indicators that you have mentioned already. You're looking at businesses that are struggling just to survive, let alone try to create jobs. How does increasing your interest rates actually help the situation?
No, actually, it doesn't help, right? And I think there are several things, and you ask the question, who has to listen? I think the first issue is that there needs to be an increased pressure on government to amend the constitution and give Reserve Bank dual mandate. That's the first issue. By the way, the ANC in its manifesto of 2019 had actually taken a decision to actually amend the mandate of the Reserve Bank to include employment. And that's why other economies have not gone into this 75% basis point, because they need to balance their intervention. They fully understand that we have a responsibility for price stability, but also at the same time, we have to create employment. And if we increase interest rate, we're choking the very private sector that is meant to create, to increase to create jobs. Now, in economics, there's something that we call macroeconomic space, particularly monetary policy, is a contested terrain. And at the heart of that contestation, it's because that those who are powerful and who get to benefit from interest rate increases or macroeconomic austerity measures, right, tend to have an influence in terms of what type of monetary policy choices that the economists settle with. So the key question we must ask is, why has the ANC not implemented its own resolution, right? Why are we still 4 years after 2019 elections that we have not been able to actually implement the dual mandate, which is actually implemented across? Now, we often, one of the economists have been saying, oh no, when the global economies or federal monetary policy banks increases their interest rate, we have to follow suit. And that's probably true. But I think they are much more considerate in how they implement their inflation targeting or price stability management, because they understand the responsibility they need to fulfill. So it's clear in South Africa, by the way, that the very majority of citizens, right, who are actually trapped in poverty, 40% of Black women are economically disengaged and are taking unpaid social reproductive work. Young people, 66% of them are actually unemployed, right? We've not been, the only sectors in this country that have consistently been creating jobs is actually public sector. One of the key issues, by the way, if I may make my last point, if you look at the monetary policy statement, interestingly, which for me I really find it contradiction in terms, is the fact that the MPC recognizes that the public sector capital formation has become weaker, they are not spending. So it means that by introducing or increasing interest rates, you are actually saying, no, we're clear about a macroeconomic austerity measures. The public sector that is meant to be an arbiter by making sure that it's spending, it's making this country a construction site, meaning that it's actually supporting the demand side of the economy, right? It's not doing anything, right? But then instead, what the monetary policy does is to top it up and just, chop the economy by increasing interest rate. So in essence, immediately what you see is that there's a poor coordination, because after that, what we're supposed to be hearing from the government, even on the first interest rate increases, where government was supposed to say, here is 100 billion we are presenting to the economy, infrastructure, we're building so many roads, so many rail infrastructure, and we're recruiting so many young people. So in essence, even though you know that the currency has lost its purchasing power, but you know that people still have access to income and they can lead affordable life and decent livelihoods.
So, Phelisa, some economists actually have put the blame squarely at the door of politicians for the policy failures, saying that the Reserve Bank is being used as a scapegoat for the fiscal policy failures, and that's where economic accountability should actually be expected from. What's your take on that?
There's yes and no. I think the first issue, the yes part, it's true that we have given Reserve Bank a singular mandate of price stability, right? And saying we're delivering on it. We have no other responsibility. And then when I'm saying no, I'm saying yes, we have to blame them. But also the other issue is that we're saying that actually they are being conservative, because the definition of the mandate says balanced and sustainable economic growth. So if you understand that concept of balance and economic growth, why are you not using other tools within the monetary policy which will allow you, which is amongst those is, if you control your interest rate increase to 25 basis points, then you allow actually private sector companies to be able to build instead of choking the economy with 75%. I think the second point, yes, is true, that in fact, if we stick to the current mandate, they are correct, right? Because what is happening is that the fiscal policy is meant to support what if the monetary policy is taking an austerity measure, the fiscal policy has to be expansionary. In this context, we need to see increased spending. We need to see spending in hospital, bridges, roads, and whole public works program. Now, the issue in South Africa, for example, the last time we've experienced just above 2% economic growth was about 2010, and as well a little bit of 2015 and 2016. And because at that point, the Minister of Finance sent a letter to the Reserve Bank and says, please control your interest rates. You can't actually continuously increasing the interest rate. Now that's called macroeconomic coordination, because the minister responsible is actually alerting and saying this economy cannot survive with another 75% or with another, let me just say, monetary austerity intervention. And then in return, we started seeing the increases. But the other issue, which is a bucket, the third issue, which that's what politicians sit with, right, is the whole allocation of resources for industrial policy development. Okay, not policy, but for industrial development, by the way. In South Africa, we're spending 60% on social security and 10% on industrial policy. So what's the message we're sending? We're actually saying that we want to build a society where we are systematically and structurally passing on intergenerational poverty, where if you and I give birth tomorrow and we're not able to afford, we are going to automatically go into a social security system. Instead of you and I, Sakina, as professionals, we can be able to actually earn a decent income and sustain our families by accessing good jobs and good wages, and then we don't have to actually earn an income. The other example I want to make, in 2019, there was an infrastructure project in about 6 provinces in this country. We picked up about 100,000 people had not drawn their social security, meaning their cash grants, because they were earning a decent salary from an infrastructure project. What that means, it's a strong indication that South Africans are ready to work. South Africans are also looking for not only decent jobs, but also decent wages. And immediately after the infrastructure project had come to an end, they all went back into social security. So what it means is that, in fact, the 60% spending on social security is actually inappropriate. In fact, people are ready to. But obviously, for you to increase your industrial development spending, you need private sector into the party. But that private sector has to be driven by a very clear vision on what economic sectors in this country we deem to be strategic. So that when you increase your GDP spending on industrial development to 20% to 30%, you know that these sectors are quite important. Because what even makes our economy even more vulnerable and compels the central bank to increase interest rate is because of a propensity to import. We import consumption goods here, which we have capability to be able to manufacture. But because there is no clear microeconomic coordination, from the industrial development perspective, because that microeconomic coordination requires financing, and the state is the one economic actor who needs to finance that industrial development to make it sure that you and I don't have to buy anything from outside, or if we do, we buy minimally. I mean, for instance, simple issue, textile industry is linked to agricultural sector. In South Africa, we have less than 2,000 cotton producers, some of them are actually subsistence farmers. You can imagine, in the value chain, how much we're losing, because everything else we get to import, clothes, jackets, etc. We get to import from outside when in fact we could be coordinating. And part of it also reflects the lack of state capacity, because the people that we've been recruiting in the public sector are not don't have the expertise of coordinating industrial development. All they have expertise of is public sector government. So we've not embedded industrial development within public sector government. And all we have with assistant director, there's no project management skills, limited industrial development, but also there's also polarization in how the state coordinates its responsibilities between the three spheres, even within amongst the national, the central government. So there's massive opportunities, for example, with the development, and I hope you follow my thought process with the district development model, because at the heart of it is that there's going to be an increased demand to decentralize industrial development, both in terms of resourcing, planning, design, and as well as expertise. Because central government is sitting with a lot of expertise that could be actually be sent to local municipalities to build, because economies are built from local. They're not built at national level, which is Pretoria. They're built in your local municipality, in my local municipality in Butterworth. They're built in Giyani. They're built in Buchabel. They're not built in national. And we need national government to release those expertise to help municipalities to build vibrant economies. And that must be followed by resourcing. And fiscal policy and industrial planning is sitting with that resourcing.
Well, that unfortunately is where we're going to have to leave it. But thanks so much for your thoughts and inputs. Development economist Phelisa Nkomo weighing in on the ongoing discussion of whether interest rates are the best instrument to target inflation for the South African economy, with high unemployment, poverty, high levels of inequality as South Africans buckle under the high cost of living.